Now, a new Moody's report is optimistic about the outlook of Kenya's banking sector this year. To help break this down for us, we were joined by Moody's analyst Christos Tefilu for more.
We have recently, as you said, assigned a stable outlook to Kenya's banking system. And this effectively reflects our expectations of banks' credit fundamentals over the next 12 to 18 months, and we expect these fundamentals to remain stable. So what has changed? I mean, obviously we had the pandemic. Since the pandemic, we're expecting a rebound in economic growth of over 5% this year and the next. This indicates limited permanent scarring from the pandemic on the economy. And this, in our view, would lead banks to continue to improve their profitability and loan quality. Since the pandemic, I mean, in 2020, both loan quality and profitability has deteriorated because of higher losses that the banks experienced. And we expect going forward an improvement to pre-pandemic levels. High problem loans, we believe, will remain one of the key challenges of Kenyan banks. However, a drop in these metrics, these levels to pre-pandemic levels, closer to 12% of total assets, is something that we expect over the next 12 to 18 months. In addition, at the same time, overall for the system, the capital, the solvency, and the liquidity profile of the bank should remain stable and solid. Again, supporting our overall view for a stable outlook over the next 12 to 18 months.
Yeah, Christos, I just want to go back to your second point regarding the NPLs, right? You expect these to drop to about 12%, but at the same time, 12% was pre-pandemic numbers, and here we are looking at 2019 as the base year for that, if we were to ignore the 14.6 and the 13% over the past 2 years. Now, if they're dropping to 12%, but then the quality of the loans being taken out of the banks isn't improving, doesn't that put the banks between a rock and a hard place?
Yeah, we always like to compare, with more recent performance. And actually, we've seen that during the pandemic, as you mentioned, there was a peak in the NPLs of 14.6%, and since then we're expecting a drop over the next 12 to 18 months to 12%. So, an improvement, is something meaningful. On the other hand, as you highlighted, as you hinted, I mean, 12%, it's still a big number, and this reflects pre-existing conditions, I would say, pre-pandemic, where NPEs were always closer to 10%, a bit elevated. And this reflects structural challenges in the economy, like we've seen some of the corporates historically facing difficulties, a lot of them because of corporate governance issues at one or two large corporates. In addition, we've seen delays in payments and problems with liquidity in the system. And we also have still high interest rates overall in the system. I mean, we no longer have the cap, but we have a bit of a delay by the authorities to approve the pricing models of the bank, so the lending rates have remained quite elevated, and all of these lead to what is a still elevated level of around 12%, albeit an improving level compared to 1 or 2 years ago.
And Christos, so where does this put the banks, and here we're going by estimations, in terms of their loan-to-loss provisions for those NPLs?
Yeah, we actually seen the banks since the start of the pandemic building these loan loss provisions. The banks took more losses, let's say, more provisions against not just the asset quality deterioration that they've seen, but in anticipation of further asset quality deterioration, because at the time the banks weren't exactly sure about the whole impact of the pandemic. So they wanted to take the provisions up front in line with the accounting standards that require them to do so. So we've seen banks building the provisions over the past 2 years. It has increased to over 70% from around 60% or a bit lower pre-pandemic. And we expect overall these provisions to remain around those levels as the NPLs also drop. That will clearly support the provisioning level. So now the banks are much better provisioned than what they were a few years ago.
Liquidity is the unsung king, at least that is something many have been talking about during this crisis. And even prior to the crisis, Kenyan banks' liquidity assets stood, at more than 50% there. Right now, they languish at about 42%. Do we expect this to remain the way, even with the coming in and broadening of digitization?
Yeah, liquidity is definitely something that has improved. During the pandemic, we've seen deposits increasing more than the loan book, and the banks invested this excess liquidity in government securities and other liquid assets. Prior to the pandemic, we also had the interest rate cap environment where, again, banks didn't lend that aggressively. They preferred to hold more assets in liquid form. So over the past 3-4 years, we've seen a gradual growth from around 25% liquid assets to total assets to closer to over actually 40%. So now the banks have much more liquidity. We feel that as the economy improve and as we put the elections behind us, where in the run-up to the election there may be a bit of uncertainty, a bit less growth in the loan book. When we put that past us, we feel the banks will grow more their loan book, and we expect liquidity to drop slightly, but to still remain at strong levels. So the current liquidity profile of the banks allows them to fund potential new lending opportunity, both in Kenya, but also in the region where increasingly the Kenyan banks are present in.